understand that they need to collaborate on something like AI. So both those stocks are in focus. But apart from all of that excitement, look at the bond. Yeah.
Yeah, no, just one small, did you know, because, I mean, even I didn't know, obviously, but I looked at the tweet from Charlie, because, I mean, even I didn't know, obviously, but I looked at the tweet from Charlie Bilello, and it says that Apple has 6.3 times the revenue and 3.3 times the net income of NVIDIA. But the market cap is just 1.2 times higher.
But who has the chip?
Yeah, I'm just saying it's been a crazy run for NVIDIA.
It's crazy, and it's also telling you how the one who has the technology first can zoom ahead. It's fascinating times. Not so much for the 10-year. Where
fascinating times for the 10-year as well.
I think more concerned than anything else. So look at what's happening to the 10-year, inching up for about 4.38, 4.36. Yeah, 4.36% ahead of the Fed meet, and that is going to continue. Not great for the Brent prices and for crude either. So Iraq, Saudi Arabia both have said that they're going to go slow on production, on exports as well. They have to meet their OPEC plus targets. Russia oil supplies are also under concern. So you had the Brent closing in on even an 87 kind of a level. Asia is the other one to look out for. And just before we rolled on the show, we were talking about Bank of Japan and how important that would be or would not be. So we're waiting to hear from Bank of Japan whether they will raise rates this month or next. Will they, won't they, is the big question after 17 years. Asia stocks are not very positive thanks to that. Let's quickly look at the implied open and what the mood will be in India. And yeah, that's looking negative at this point, possibly about 79 points down. Quick look at fund flows before we get to the trade setup of the day and how the day really ended yesterday. So we are in this range-bound kind of a situation. You had, DIS selling, FIS selling 2,051 crores, DIS 2,261 crores in purchases, but it has still been no clear direction, I would say.
100%. In fact, the only thing that stood out, and that's a part of the trade setup as well, the only thing that stood out the last 3-4 days is that this 21,900 has been tested now for 4 consecutive sessions. If you are thinking of the Nifty being on an uptrend, then it wouldn't go down to test those lows. So sadly, that is happening. If it gets broken, then who knows what happens, but until now, so 2 ways to look at it. Is the glass half full that it's testing and coming back, or is the glass half empty that it's constantly testing that? So that's the first piece. 4 consecutive sessions we've had 21,900 being tested. Now the max put OI is at 22,000. So does that become that crucial support for the day today? And if that gets taken out, do we swiftly move on to 21,900, 21,800? Now that remains the key point to monitor in the session today from a Nifty perspective. But as we know, the market is now shifted to beyond the Nifty. While we talk about the Nifty at large, the broader market's behaving a lot differently than what the Nifty does. So that's to keep in mind that the small caps did reasonably okay yesterday. And let's see if this week also they do a bit of a bounce back selectively relative to what they did last week. So I think that's the key focal point. Metals saw a whiff of hope yesterday, didn't they? I mean, with all that's happening in China. But most people that we spoke to a guest on the closing show yesterday as well. We spoke to Rakesh Arora a few days back as well. Most people shying away from taking positional bets on metals. Yes, trading plays could happen intraday a couple of days, but positional trades on metals, preempting what China will do, is something that is out of the equation. So be careful if you're making those positional long bets on metals, maybe fraught with a bit of risk because of the uncertainty around that. And I mean, frankly, everybody talking about how stock-specific bets more likely in the value zone, likely to be the order of the day. And we saw that yesterday, right? I mean, stocks like Anup Engineering, stocks like Divgi, a clutch of others which were in this heavy engineering space, providing value because of growth, had some massive moves in trade yesterday. So bet on value, don't try and bet on high-priced stocks. That seems to be the mantra, at least as far as dealing rooms are concerned.
Makes the list very, very short.
Very short.
I mean, it's a handful of stocks that still look great and are not in the price. But, we were discussing that Indian markets are struggling at 21,900. Niraj, if you look at it, there is really no positive trigger to go out and buy. In fact, when Siddharth Bhaiya had that conversation with you last week, the one conversation I had with him was, he said they're going out for a Far East specific fund. So my concern now is that anything that could potentially come into India is finding its way into markets like China. Better than expected growth, metals looking good, are factors, and of course, very, very cheap valuations make China now, I think, a strong competitor to potential inflows coming into India. And I think that is one reason why we're still not getting the piece of the pie as much as we're eyeing it. Or buying it.
I think that's also a factor of waiting for the elections to be over. That could also be one of the reasons. There is money waiting on the sidelines for this big event to get out of the way. That could be
which is what Aditya Suresh of Macquarie said, that in their meetings with the FIIs, the FIIs are saying we want the formal tick mark to be out of the way. Correct. So we know that there is a likely policy continuity, but we want it to be formally done before you put in the money.
But if that was the case in the last couple of election times, the post-election rally hasn't been significant.
Very likely.
It's buying the news and selling the rally, or buying the rumors, selling the news.
Yeah.
And that's been the texture of worldwide markets across asset classes, right? One could argue.
But the only difference, and I don't have, I don't know any of us have the data of what the FI behavior was preceding those elections, but preceding these elections, FIs haven't been putting in the money by the droves, so maybe, just maybe, hopefully that changes.
I mean, what I am hearing is that, while we've talked about this since October, is that China is looking very, very compelling. So if you are vying for flows coming in on back of value, and remember, valuation has always been a concern for foreigners, right? We're not at our historical highs, but we're still not a cheap market by a mile. And that's, of course, DIs have limited options in terms of buying what is available. You really don't have much of a choice beyond your home market. But for global investors, India, China is an outside and foreign market. So this is just one piece, which probably means that there's no big trigger at this point to help the markets go up. But nevertheless, 22,200 on the upside is also proving to be a quite level of resistance. While you've seen a little bit of recovery across the broader markets, they've still underperformed the benchmark in yesterday's day of trade. GIFT Nifty indicating to flat to lower start, so not too much fireworks expected. It's going to be the stock-specific trade, like Niraj said, and rotational buying that the markets are currently witnessing that may continue into today's trade as well. Let's quickly highlight a few stocks that are in focus. OMCs will be in focus this morning. Remember, crude is inching higher again. Exports coming from Saudi and Iraq have reduced. There are early signs of an increase in demand. All that is keeping oil prices elevated. Not good news coming in for OMCs, which already are dealing with the fuel price cut that took place last week. So these counters, once again, could be on the sell tab for a lot of traders. Apart from that, Tata's group companies haven't stopped grabbing our attention for the last couple of weeks. And this morning, too, it's no different. It is TCS that's in focus. Not too much in terms of a stock reaction. Of course, you will get a gap down in the early hours of trade, but the story here is that Tata Sons is looking to sell 2.3 crore shares at the price of 4,001 rupees a share, while a block deal in TCS, they're looking to raise close to 9,000 odd crores. This amount that is going to be raised will be used to par debt that Tata Sons has on its books. Remember, the Tata Group stocks have been in focus in March after there was a note which Spark Capital sparked about a possible listing of Tata Sons by September 2025, as it will complete 3 years of being notified as an upper layer NBFC by the RBI. So all these things that Tata Sons is doing is actually part of the course to avoid that listing and not to remain an upper layer NBFC that would be required to be listed by the regulator. Tata Steel is well in focus. This one is good news in some ways. They are looking to stop operations of coke ovens at Port Talbot in Wales. After there's been a deterioration of operational stability, they will increase their import of coke to offset the impact of coke plant closures. Now remember, this is part of their restructuring plan. They plant of theirs in Wales has been losing £1 million daily is what they've indicated, and that could also lead to a further £600 million loss. So all part of restructuring. They're moving to better and more efficient green energy, and hence this could be another big positive because they finally pulled the plug on this plant and are in talks with unions in the UK to ease the situation there. Well, this is a statutory requirement coming from Aditya Birla Sun Life AMC, where the promoters are looking to reduce their stake. This would be done through an OFS. The floor price of this comes in at a discount. Remember, the promoters cannot hold over 25% in the entity, on back of which you will see this. The stock will react negatively, but again, a regulatory requirement, so not too much in terms of a reason for that reaction. So those are the three big ones. In that sense, Tata, of course, grabbing highlights this morning.
Yeah, most certainly. And you know, just thinking that if this is coming out, then do the resultant beneficiaries like Tata Chemicals, etc. also
still gain again?
No, come down today, right? Yeah. Because if the Tata Sons IPO is getting postponed,
it was. I think we're done with that. 40% gain, 25% correction. I think the market has moved on.
My question is, will they sell in other group stocks as well, or is it only Tata Steel? Is this just the beginning of a larger picture?
So I did discuss that with Vishin. I think he's going to talk about that. But they hold stake in 700 companies. So it's going to be a tough one to go out there.
Also, the quantum of money that they need to pay.
And we don't know how much debt they have on the books.
At least I don't know. Yeah, but I'm just watching out for Tata Chem. Let's see if there is a resultant impact. Very quickly, a couple of stocks that I wanted to highlight before Tamanna brings in. You know, we're talking about what IT is doing, etc. and stuff like that. And while TCS is saying what it is doing, Citi has this note wherein they have had a conversation with the Mphasis CFO. And the Mphasis CFO is saying, this one line is crucial, the Mphasis CFO is saying that there is no change in the demand environment since the start of the quarter. So much as we're talking about whether there are conversations or demand picking up, the Mphasis CFO is saying there is no change in the demand environment. They're saying that growth in quarter four will be likely better beyond the benefit of the reversal from the furloughs, of course, led by BFS, but no change per se. Margins will remain in the guided range. So thus far, there's no reason to be extremely bullish on tech, thinking that demand environment is changing. It is not.
Not until the elections are the way in the US too.
Maybe, or the rates. Yeah. So you may be right, but I'm just saying that as of now, there's no evidence. So any kind of upticks in IT, Pied Piper stories, part one. Part two, Poonawalla FinCorp is very interesting development out here for multiple reasons. One, HDFC Bank veteran Arvind Kapil, new MD CEO, great for Poonawalla FinCorp, right? Good face coming in, etc. and stuff like that. Is it a big negative for HDFC Bank? That's the question. So Jeffries is saying that the development is tad negative for HDFC Bank as well as Bajaj Finance, because Poonawalla FinCorp, according to them, is one of the closest competitors to Bajaj Finance. And if they are getting a veteran, then it may impact Bajaj Finance as well. So it could be interesting. They are also eyeing, watching out for any exits from Kotak. So that was the other interesting bit. I don't know why, but
so the thing with the HDFC personnel who's coming, Kapil, he was heading their entire retail play, which is so he's an important cog in the wheel. Big dependence on him, and there's more HDFC notes out today, which we will get to. But that's definitely.
So Nomura is saying that they are not too worried because HDFC Bank has depth, and also it's one opinion versus the other. But it is very interesting for Poonawalla FinCorp per se, and also for the allied places like Bajaj Finance and some others.
You know, talking about HDFC Bank, and this is what I've been hearing, and I think we talked about this as well. The second rung management at HDFC Bank is going through a massive churn. So the head of private banking had recently moved on to corporate. There were churns from the NRI team that have moved to private. So if you look at it, I mean, all of course we hear about is the top level changes, but the management, the bank itself, is going through a serious recheck at level 2, which is really the guys who get stuff done, right?
That's interesting. Yeah, those are the cogs in the wheel.
Yeah, just very quickly. Sorry, just before Tamanna goes it, and the last set of stocks, just we should keep an eye out for. Coforge yesterday was very interesting, the price movement. So just the price volume action that we've seen. Coforge was down 7% because of this block QIP, and whether there is some M&A activity out there. That's the rumor mill on the street. 3.5 times the delivery volumes. But the others, 3 small names, very interesting price volume action on your screen. Hindware Home, 9.5% higher on 9 times 1 month average delivery volumes. Spark and Network 18, which went up 4% on 15 times the delivery volumes. So very interesting mid-size small cap names in focus today.
Yeah. So just since we're talking about financials, L&T Finance was another one that I wanted to put on your radar. Their board approved a fundraise via non-convertible debentures yesterday, and the upper cap that they've set is quite an astonishing one of 1 lakh crore rupees. So one way to look at it also is how all of these players are padding up for a big war within that financial space with the competition heating up. So L&T Finance is one I'd watch out for. HG Infra is the other one. There has been more news coming in recently about order flows, but as such, relative in the infra space, the stock has not performed too well. In a year, up about 16%. In 6 months, down about 7%. But the latest is that they have got a clutch of orders, 4 LOAs actually, for solar projects from Stockwell Solar Services, and the aggregate value is about 1,026. So if you look at it versus their order book of 9,600 odd crores, so not too bad. So HG Infra is the other one. JSW Steel I found interesting because the company has issued a clarification that they did not make political contributions to the JDS, that's the Janata Dal Secular, in electoral bonds. And this is going to be one overhang on the market as well. You saw yesterday Biocon's chief come out and explain that she donated in her personal capacity. Now JSW Steel is saying that we did not contribute to JDS via electoral bonds. The JDS data with the Election Commission said they did. Now was it as a company, was it not JSW Steel, remains to be seen. But I just want to also put out this one quote when Kiran Mazumdar-Shaw spoke with us exclusively, in fact, and it reflects the kind of concern that corporates have over this whole electoral bond situation. It's going to peak on Thursday because now the Supreme Court has directed that SBI should put out the alphanumeric details which would allow anyone to match donor to recipient from the political parties. And she says we should not give up on electoral bonds as conceptually it was aimed to bring in white money into election funding. We need electoral bonds version 2 that strikes the right balance of confidentiality and disclosure. So this might be an overhang that you could see in the market as well.
It is. Electoral bonds are leaving us anytime soon from the look of it. But very quickly, 2 listings. You've got Shipping Corporation of India Land and Assets. It's the demerged non-core entity of state-run Shipping Corporation of India. It will be debuting on the exchanges. It is only for trade-to-trade segment. No buy today, sell tomorrow trades would be allowed. This one's important to watch out for the stock. In fact, SCI was one of your big gainers in yesterday's trade on back of this listing. The other thing you want to keep in mind is that this was part of the government's initiative to disinvest a chunk of those non-core assets. Well, as per the Shipping Corporation's 2023 report, the value of these non-core assets stood at 2,392 crores. So this one is important. It'll be exciting to see how SCI, whether it continues a positive up move on back of that today as well. You've also got Popular Vehicles and Services. They will be debuting on the exchanges at 10 a.m. The final price has been fixed at 295 rupees a share. There's not too much of a premium on this one, the grey market this morning, Tamanna.
I'm feeling bad for those who are debuting now.
I know, right?
It's just 4 or 5 months ago.
This is just luck.
It's just changed.
So you're lucky if you list flat.
Yeah, if you made it. Just a couple of stocks before I go over to Alex and Editor's Cut. Signature Global is one you may want to keep on your radar. They've completed an acquisition of 100% stake in the Gurugram Karma City Private. It's now a wholly owned subsidiary effective today. Real estate has been taking a bit of a knock. So Signature Global is one you could see. I picked Veritas because I just found this whole concept of this project they've got very interesting. They've, got an LOA from BMC for 156 crores. And what they're going to make is a 3D model of Mumbai city, which the BMC is going to use to make decisions of how to run this city. And I just thought that was pretty cool. So which is why. Page Industries is another one because there was another brokerage house which initiated a buy rating on it today. Citi has a sell rating today and says the demand environment will remain subdued. The new customer acquisition in men's innerwear also remained subdued. So this company, which owns the Jockey brand, may see some concerns. Well, so a lot that we've spoken about already, but we have to focus on the story this morning, which is definitely an interesting one. What are these moves that Tata Sons is making, and what is the reason?
Well, thanks so much, Tamanna, for that. And this is, by the way, Editor's Cut. This is where we get you beyond the story. And so we will delve into the exclusive details of what Vishwanath Nair, my colleague, has picked up with regard to this entire Tata Sons saga, if we can call it that. But if you are unfamiliar with what has happened so far, Vishwi will also be able to contextualize it to tell you why Tata Sons is possibly doing what it's doing. So let's start, Vishy, with what the latest update is, which is that there is a stake sale that is being talked about for TCS. How much and why?
So what we understand is that 2.34 crore shares worth 4,000 rupees each. That's the sale price that they've decided, which is a slight discount to where the stock closed on Monday, about 3.6% discount. That adds up to about 9,300 odd crore. And that 2.3 crore shares, they represent about 0.65% stake in TCS. Tata Sons on their own 72.4 odd percent.
So not a material
not amount. A material part of their holding. Why is this happening? That's an interesting question. So this money that is raised is likely going to be used to repay some of the debt that is there on Tata Sons' book. Why is that important? See, Tata Sons went from a publicly held company to a privately held company in 2017. This was after N. Chandrasekaran took over as chairman of the company, of the group holding company. The Reserve Bank of India's new guidelines on NBFCs and how NBFCs are treated in this country, they suggest that Tata Sons, which is a CIC, a core investment company, which holds multiple financial services business under it, will need to list by September 2025. Those are the rules. Now, September 2022, they release a list. Say 3 years later, you have to list. Obviously, Tata Sons only in 2017 went from public to private. So there is no reason why Tata Sons wants to list now. And what they're trying to find are ways to avoid this.
And they went private, correct me if I'm wrong, because of the change to the leadership by N. Chandra.
Exactly. This case was discussed widely in courts. But at the end of the day, they do not want to list. They are not interested in it. N. Chandrasekaran has gone to the Reserve Bank to seek some kind of exemptions. The RBI said that they don't want to really give any kind of exemptions to Tata Sons because that will send out the wrong message. What they are doing now is two things. One is this clearing of debt, and the second part is to restructure the company internally. What we understand from sources is that likely step that is going to take place is that the group is going to restructure internally to move all the financial services businesses into another entity, which is separate from Tata Sons. And maybe according to RBI rules, they can go ahead and list.
So, but two questions then. Why is the debt on the books of Tata Sons significant in terms of the rules? What in the rules requires Tata Sons to remove the debt on its books to avoid listing?
So, public financing. Basically, one of the main reasons why RBI acts a certain way is to protect public money that is linked to corporate entities, right? And because here there are financial services entities, therefore RBI comes in with NBFC norms. If once you clear that debt, then any linkage to public finances with Tata Sons, that goes away completely. Then they're their own entity with their own funds, and whatever they earn through dividends from their various holding companies, that continues as is.
And then the second question, of course, is what you've spoken about in recent days as well, which is the creation of a holding company for the financial services entities. But how will that ownership structure look? Is it okay for Tata Sons to be an owner of the holding company, which in turn owns financial services company?
So from what we know so far, yes, that structure is kosher according to what the RBI looks at, how they look at financial services businesses. So the holding company is the one that will actually need to list, not the owner of the holding company. They're exempt from any kind of listing. I mean, so far that's what's been continuing with every other financial services entity. That's how it works.
So, and just for the complete closure of this conversation, what are the entities that will then form a separate structure?
There's a bunch of financial services companies within the Tata Group. There's Tata Capital, Tata Motors Finance. You've got the life insurance business with AIG. So mutual fund, of course, all of these entities form part of the financial services business of the Tata Group, and all of these will need to then move out of Tata Sons.
So quite a lot of restructuring for the Tata Group as a whole, and let's not forget that Tata Motors as well is undertaking a bit of a restructuring of its business to streamline its passenger vehicle as well as commercial vehicle business. Not related to this, but important to pay attention to nonetheless. Rishi, thanks so much for laying that out. And by the way, if you've got any questions about this, do write to us on our social media platforms and stay tuned. Lots more coming up before the start of trade. This is NDTV Profit.
Welcome back to India Market Open. Let's start with the top headlines that we're tracking this morning. Tata Sons looks to sell 2.34 crore shares or 0.65% stake in TCS. That's one of the two steps it is taking to avoid the RBI's mandatory listing requirement. US stocks rise on an AI-fueled rally as investors digest news from Nvidia's AI conference. Two-day FOMC meet kicks off today. Goldman Sachs economists have dialed back expectations of rate cuts by the Fed to 3/4 point cuts instead of 4 for the year. And Aditya Birla AMC promoters, Aditya Birla Capital and Sun Life AMC, will offer nearly 11.5% stake through the OFS route. And the government unveils draft rules to exempt select combinations from CCI approval, also releases the draft the minimis MIS rules to elevate scrutiny on small companies under the Competitions Act. Well, those are the top headlines we were tracking at 8:30 a.m. this morning. Implied Nifty indicating to a marginally negative start. No surprises there on back of mixed global cues and the fact that there is a lack of direction coming in for the street. Agam standing by, as always, with the F&O picture. Agam, morning, 21,900 important on the downside and 22,200 turning out to be quite a resistance for the street.
It certainly is. It certainly is. We are looking at 20,000 at the moment, and the Nifty, it seems, it's been taking support there. But you never know how things can, in fact, move. And it's been a tough market to trade, and that's very evident in the kind of numbers that we've seen, or rather the lack of change in open interest that we've seen in the March series so far. For the 10th straight session, the overall open interest number for the March futures continues to be, well, between 250,000 to 260,000 odd in terms of OI. The Bank Nifty futures, the picture isn't very different, underlying flat and, well, more unwinding coming through, this time to the tune of nearly 5.5% to 6% coming in. What about your overall options picture? Well, considering the Nifty, well, stayed at around 20,000, or rather 22,000. That's exactly where we saw a little bit more of writing in both calls as well as puts. So keep this mark, keep this level in your mind when you, in fact, go ahead and trade, of course. In terms of your overall picture with respect to the maximum open interest, we're keeping an eye on, well, 22,500 on the higher end. That's where your call max OI is. And on the lower end, you have 22,000, again, with max OI and puts. Moving on to the Fin Nifty expiry, is currently, which is at around 20,600, 20,700 odd levels. Those are the levels that we will be watching out for as far as the Fin Nifty is concerned. And finally, coming down to stocks. Again, it was a mixed day of trade. We are looking at longs for Balram Puccini and Zydus Life. Of course, Coforge, Apollo Tyres and Dr. Lal Pathlabs did see some shorts coming in. And among stocks which saw unwinding, longs unwinding for Hindustan Copper, HDFC Bank and BPCL, and short covering for ITC and NMDC. This is as far as the markets are concerned. The question really is, what do you do with these markets? Where do you go from here? And how do you address the Nifty, Bank Nifty, and, well, several other stocks? Let's get an expert opinion. We have Ajit Rambia of Ajira Ventures who's joining us on the show right now. Ajit, good morning. Thank you so much for joining in. Let's start, as usual, with your view on the Nifty and the Bank Nifty. What's the way forward here?
Yeah, good morning, Agam. Thanks for having me on the show. Considering recent market trends, we have witnessed a decent correction. So we expect a subdued market movement, particularly in the small and mid-cap sectors, until March end. So, however, we do anticipate a bullish run in April. So the flow is like we have had a downtrend. We will continue the downtrend up to March end, and then we'll have a bull run. We strongly feel healthcare and insurance sector will outperform post-elections. Speaking about the indices, in Nifty, the recent bottom of 21,900 is seen to be a good support, and we face a resistance at around 22,150 levels. And in Bank Nifty, the recent bottom of 46,100 will act as a good support, and the resistance is placed at 46,850 levels.
Okay, right. So let's move on and talk about stocks. And I believe that you have an idea on Ambuja Cements. Can you take us through that?
Yeah, so we have a bearish view on this counter. It has been showing some weakness. So we initiate a bear put spread where we buy a 580 March put at 8 rupees 65 paise and sell a 550 March put at 2 rupees 5 paise. So the cost of this strategy is 6 rupees 60 paise and the profit is around 30 rupees.
Okay, so a bear put strategy and expecting Ambuja Cement to go lower, and which is why this implementing this one. Ajit, I believe you also have a view on Canara Bank. Can you take us through that?
Yeah, so Canara Bank has been a trending counter. So for the past 6 months, company has declared a stock split in the ratio of 1:5. Our view stays bullish on this counter, so we can initiate a bull call spread where we buy one Canara Bank March 560 call at 10 rupees 20 paise and sell one Can Bank March 600 call at 1 rupees 95 paise. The cost of the strategy remains at 8 rupees 25 paise only, and the profit to be earned is around 40 rupees.
Okay, so there you have it. That's the other one which can be in focus. Of course, we are in very, very volatile markets, and even though it may look like we are seeing consolidation, don't forget that we have, in fact, seen a lot of choppiness within on an intraday basis, and that in fact has also changed the complexion of the market. Of course, as we approach the elections as well, we are also looking at an ever so slight increase in the India Volatility Index, and of course, that is a consequence of the change in the the structure for option premiums. But on that note, Ajit, we're taking a moment to thank you for joining us and taking us through your views on the markets and giving us a handful of ideas. And with that, it's over to you, Samina.
Hi, thanks Agam for that. That is the F&O picture this morning. It looks like it's going to be a quiet start. Don't expect too much in terms of fireworks. Lacking direction for now. That's what we have in terms of the street activity. Well, we're also, remember, awaiting Bank of Japan's rate decision. There is some parts of the market that believe that this could be the end of the negative rate cycle for Japan. They're one of the last countries to actually continue with one in their fight for deflation. So a rate hike there is something that the markets are watching out for. But let's shift focus back home again. A quick check on what stocks the street will be tracking today. Anushi joins in with more on that. Anushi, what do you have on your list this morning?
Hey, morning Samina. So first on the list is Aditya Birla Sun Life. Over here the founders are considering an OFS that is offer for sale of up to 7% now at a floor price set of about 450 per share. Now over here the founders are also considering an additional stake sale of about 4.47%, so that also remains on the watch list. Again, the founders currently hold about 86.5% stake in the company, so this is in the view to ensure that they are in the minimum shareholding requirements agreement. Again, onto the other holders of the company, the FIIs hold about 1.75% stake in the companies, while DIIs and retail hold about 5.2 and 6.6% stake. Moving on to Aegis Logistics over here, this is in focus after the company's unit has approved acquisition of a specialized storage terminal at its Mangalore plant, with a proposed capacity addition of up to 85,000 kiloliters. Again, this entails a project investment of about 75 crore, and another 50 crore also remains in focus for additional capacity under construction. The mode of financing for this should be through the internal accruals of the company. And lastly on the list is Lemon Tree Hotels, which is in focus after the company has signed a new hotel property in Tripura. This property is expected to become operational in FY27, and this is to be managed by Carnation Hotels Private Management. So these are the three stocks that should definitely be on radar for today.
Yeah.
All right, thank you for that, Anushi. So, quite a few stocks on the radar this morning. Let me go across to Soni Patnaik, who's joining us now. She's AVP at JM Financial Services. Soni, very good morning to you. We've had, a consistent range-bound trade in the markets. What is your outlook for Nifty and Bank Nifty this morning?
Hey, good morning. Thank you so much for having me on the show. See, Nifty, I feel that, it has resumed a range of 21,950, 900 as a support, and on the upside, there's 22,150, 22,200 as a resistance. It looks weak. The FI's positioning have been reducing gradually. They started out with 46% out longs, and now they've just come down to 37% longs, which is indicating that the shorts are increasing in the system. So it can indicate that maybe the support of 21,900 may break. Any close below the support, Nifty can head down lower levels to 21,500, 21,400. So it's a bit better to maintain a cautious approach when it comes to indices. It's it's looking a bit weak right now. The open interest option chain is also indicating that some shorts are getting written on higher side of the call, such as 22,100 call, 22,200 call options. So remain hedged. Cautious approach can help better. If 21,900 were to break, you can see some more selling pressure coming in for Nifty.
Yeah, absolutely. We are going to see perhaps some selling pressure coming in for Nifty, says Soni Patnaik. Soni, anything on top of your list this morning? Any picks that you have for our viewers?
Yes, definitely. So the first would be in Apollo Hospital. Apollo Hospital, we've seen a sizable correction that has taken place of late. It was consolidating and, took the support somewhere around 59, 56,000 as a good support. It's just bouncing back now. We've seen very strong short covering yesterday, backed by good put writing at 6,000 put options. So Apollo Hospital is a buy from current levels. You can see it heading higher towards 6,300, 6,350 as well. Keep a stop loss of 6,040. To hedge this strategy, you can also do a bear put spread in Nifty. It can be done for the 21st March expiry for Nifty. You can buy a put option of 21,900 put option in the range of 50 to 55 and sell a 21,700 put option in the range of 15 to 20. So your net premium outflow for this strategy is approx 35 points. Keeping a target of 70 to 80 points in combined premium can be a target.
Okay. Sony, thanks for those ideas and thanks for that bear put strategy as well. So viewers, if you are indeed into options and puts and calls, you've gotten 3 strategies today already. Watch out for those. Now let's talk about the fundamentals for a bit. Hemang Jani Johnson with his thoughts. Hemang, good having you as always. Thanks for taking the time out. I want to start off, Hemang, with the big one, right? While IT becomes the signature of most eyes at the first port of call because there is quality there, we're seeing it unable to perform. Just when there was a whiff of an uptick, now comes the Tata Sons sale of TCS, and that brings down technically the stocks a bit more. But there is a Citi note which says that emphasis, CFO is saying there's no change in the demand environment. What do you do with IT1, and what's the specific view on TCS?
Sure, thanks for having me. I think when we look at the hard data, if you see last 1 year, IT stocks have done more or less in line with the index. Some cases, particularly mid-cap stocks, have done even better. So while the entire limelight is hogged by the small caps and the mid caps and the PSUs over last 6 months or 1 year, the fact of the matter is that IT has not done so badly. That's number one. Number two, now that we have reached these levels in terms of stock prices, IT index, etc., what are the triggers that one can really look for? When you look at the quarterly numbers or how the situation in terms of tech spend is panning out in US. So clearly things are not that clear. People are not sounding so confident about what kind of growth they can deliver, particularly the typical IT services company. Of course, the AI and the ecosystem around that and the niche category has its own story. But at an aggregate level, I would say that IT is going to be at best a market performer. I don't see it really surprising you with earnings, growth, etc. And when you have a huge supply, like what we are seeing right now, about 9,000 crore by Tata Sons, clearly, it's going to have a bit of a negative impact. Because at the fund level, what happens is that when you want to buy, because you think that the price is attractive, 3.5% discount, you have to sell some of the other IT names, and which is why we saw that selling across, some other pockets. Overall, I think it's time to kind of stay away from IT in the near term. And if it corrects meaningfully, surely it will present great opportunities.
Hemang, just wanted your take specifically on the Tata Sons news last evening to, the block deal that we're expecting today. And I just want to understand that in the perspective of the whole IPO rush that we had about Tata Sons listing, and then, a set of stories which said that they are going to try and avoid it. Do you see this move in that context, and what further kind of moves can we expect from Tata Sons to avoid a possible listing?
So see, this entire, thing that unfolded about some report having, saying that there is going to be an IPO because there is a deadline. I think the timing of that report was, a little mischievous to my mind, because absolutely there was no indication about when the IPO will happen. There was nothing from the Tata Sons side. It was just a sort of, opportunity that somebody saw to roll out a report and create excitement in the market. If you look at Tata Sons' history, time and again, they have been extremely clear that they are not looking to do IPO, and they will possibly do all that they can to avoid, IPO, because these are all, very private kind of companies, and they will want to keep it that way. So I do not think there is a reason for anybody to believe that the IPO is imminent. And we think that whatever is the regulatory requirement, or, whatever, let's say if they need funds for some of their other activities, they will keep on diluting some of these, stakes to simplify the structure. So I don't think that by itself is going to have any material impact on the stock of the company, because there is enough and more appetite for a company like TCS.
Now the question is if they will look at further stake sales in any of the group companies. But meanwhile, Soni, keen to know your take on TCS on the charts.
We've seen the entire sector, perform sort of under selling pressure, and TCS, as I can see, there's quite a lot of resistance around 42.50, 42.60 as a range in charts. On the downside, 4,000 is going to be that support level. So maybe there could just be some more selling pressure left in this stock, and until it can test 4,000, there could not be any signs of reversal or bottoming out from here right now. So maybe there is some selling pressure. Just look out for the support of 4,000. If it's not able to break 4,000, it can see some bounce back coming from those levels. But as of now, it's an avoid from the list.
Right. Soni, a couple of other names that were quite active in trade yesterday from the broader markets were stocks like Coforge and Macrotech. One on the gaining side and one on the losing side. Any trading opportunities there on the charts? How do these two look?
The Coforge, very weak. I feel that 5,600, 5,500 should be that support that it can look forward to. As of now, there are no signs of reversal. It has added very aggressive shorts even in yesterday's fall. So maybe there could be more pressure left until and unless it tests 5,600, 5,500. On the upside, only when it is able to cross 6,000 and above, you can see some reversal coming in, but that seems a bit far-fetched as of now. Talking about Macrotech, the stock has seen a good reversal from 990,000 odd levels. It's about to test 1,200 as well. I think the stock can still show a lot of strength, momentum. As of for today, 1,080 can be the support to watch out for. If it's able to hold the level, definitely it can test higher levels of 1,200.
Hemang, do you have a word on Macrotech? I mean, it's been anything but quite the start until, of course, the QIP. There's M&A activities. What we've heard about recently, the sector itself is on a little bit on the sell side. Anything that you know on Macrotech that you can tell us, and of course, what should investors do if they're looking to pick this one up?
Recently, the company successfully did the QIP, and generally on the fundamental side, or if you look at the data points, things are looking quite good. My only concern with the real estate sector is that the stocks have really run up hard, and valuation wise, I don't find them really very attractive. And so most of the good news that you're seeing in terms of the new projects, the new sales, etc., is to a great extent pricing. I would not be comfortable buying into some of these names at this point. If there's a 10-15% kind of a correction, surely Mactech or Godrej Property and some of the banking-based companies, Brigade, Prestige, this will present opportunities, but I do think that there is a case for some correction, at least in the short run.
Okay. Some correction in the short run for some of these names. Keep an eye out for these. Now, more stocks to focus on. Anushi highlighted a few. Let's get in Varsha to talk about some of the other key stocks to watch in this session. Varsha.
Good morning, guys. So, a couple of stocks that one should watch out in trade today, starting with Paradeep Phosphates, wherein a company has shut down its ammonia and urea plants at Goa. Now, this is due to breakdown of synthesis gas compressor. Now, if you see, Paradeep has 2 manufacturing facilities having total capacity of 3 metric ton per annum, out of which Goa capacity stands at almost 1.2 MTPA. Then we have IOL Chemicals and Pharmaceuticals, wherein company completes Brazilian Health Regulatory Agency GMP audit, wherein audit of all 10 API manufacturing units at Barnala, Punjab end without any observation. Now, this marks entry into Brazilian market. Note that this inspection was conducted at company's manufacturing units from 11th March to 15th March. Lastly, we have IRCTC, wherein they've approved the total project cost of 187 crore plus towards procurement of ICT infrastructure, which includes hardware, software and security system. Now, this is for setting up disaster recovery site at data center at Secunderabad for 5 years, wherein this includes capex of 92 crores as well. So, these are the stocks that one should watch out for today.
Right. Thank you, Varsha. That's a whole list of stocks that one needs to watch out for in today's day of trade. Some of them are slightly smaller, but nevertheless important in terms of stock movement. Well, in that case, we're all watching out for what Bank of Japan comes out with. There is an expectation, remember, that announcement from the BOJ should be out anytime soon. Asian markets trading flat to slightly lower. Well, Sony, have you been tracking HAL?
Yes, of course. I think the stock has resumed a sort of a sideways trend, 32 or 3,300 on the upside, which is quite a strong resistance. And on the downside, 3,000 was a strong support. So I think any break below that 3,000 level, any close below that level, you can see, more downside, more selling pressure somewhere towards 2,800. So that's a very important support to watch out for. On the upside, 3,300 is a resistance. This is quite a broad range. Or move above 3,300, you can see it resuming its further upside towards 3,450, 3,500 as well.
All right. Another story that we should keep an eye on, or a stock that we should keep an eye on this morning, is HDFC Bank. And we spoke about it in our trade setup as well. Let me get Hemang's view on this. So, Nomura note right now out this morning, which maintains a neutral rating on HDFC Bank with a target price of 16.25. The trigger, and there's a Jefferies note also, the trigger seems to be Arvind Kapil, their mortgage business head, moving out to Poonawalla FinCorp. And that entire space with key management moves heating up. What's the impact on Kotak? What's the impact on BAF is the question, Bajaj Finance. I just want to get Hemang Jani's view here on HDFC and Poonawalla FinCorp, if any.
Yeah, so HDFC Bank, I think we've seen some pullback in the last few days. Part of that was because of the FTSE rebalancing and the kind of inflows that were there. I think fundamentally in the analyst meet also, company was sounding quite confident about getting back to slightly better margin territory. Growth-wise also, things should look up. Only thing is that because it has been a stark underperformer, people will start believing once they see the actual data, in the quarterly numbers. So when the stock price moves above a certain level, from a pure fundamental perspective, we have positive view on some of the private banks, particularly, something like HDFC Bank, Axis Bank, and ICICI Bank. All three we have a positive view. And we would definitely look at buying into it while we are going through this volatility in the market. So surely overweight position there.
Right. Sony, have you been tracking Tata Steel? The stock did a pretty sharp up move in trade yesterday. It was up 4%. Fundamentally as well, there's news flow that they are looking to shut down one of their coke plants in Wales, and that's being viewed as a positive. So maybe a further leg up on Tata Steel, and if yes, if we get a flat to slightly higher start, would you initiate maybe a long for the day, intraday trade there?
I think it's best to avoid any longs in this particular stock. The sole reason being that, irrespective of yesterday's up move, a very aggressive call writing has been witnessed at 152 call option. So not a lot of upside from current levels. The support actually comes out to be 140, 142. So the risk reward is not even favorable at current price. 152 remains a very strong resistance. If it's not able to cross that or close above it, you may not see further upside in Tata Steel. Any close above 152, you can see retesting 160, then again 165, 170 can also be on cards, but it looks quite difficult. There's a lot of call writers still present at 152 call option. It's just best to, if somebody would have initiated it yesterday's trade, then it's just wise to book out your profits, and today 150, 151 around, book out your profits and hold. It's a stock that you can look forward to buying on dips rather, somewhere around 140, 135 be that range where you can buy it on dips.
Okay. What else? Just before you take that break, when you look at the set of stocks which could make a move, so aside of the IT ones and the Poonawalla FinCorp piece that we've spoken about, yesterday was some very strong moves that we saw, for example, in select pharma names, and pharma stocks have just started to make that inch higher in select cases. Yesterday was a case in point was Spark. Sun Pharma Advanced Research had a big move in trade yesterday on very good delivery volumes, and it will be interesting to see if some of these stand out in the days to come. Hemang, everybody's talking about buying value. Maybe pharma fits in there, maybe chemicals fit in there. Do these pockets excite you? And if not, what is it that you would be comfortable putting in fresh money to work at the current juncture?
Pharma in the space has done reasonably well when you look at the large cap pharma companies like Sun, Dr. Reddy, even Lupin has been a big performer in the last, let's say, about 6 to 8 months. So I think both from the news perspective, in terms of quarterly numbers, standpoint, the sector is doing well. You will have some stability come through because most of the managements are sounding quite positive when it comes to both India as well as the US generic, market outlook for next year. So I am comfortable buying into some of these large cap names. In mid cap, we do like Granules, which is corrected, in fact, from 360, 365 odd levels, 320, a meaningful correction of almost about 10-15% has happened. So surely pharma will be one sector where, this year, 24-25, it will be one of the better performing sectors in terms of growth. And in terms of valuation, it's not out of whack. I think at an aggregate level, we are getting the large cap companies at 22, 24 kind of a forward PE. Mid caps are 15-20% cheaper. So positive view on the pharma overall.
Okay. And Sony, just wondering, any of the pharma stocks that have stood out for you in the last few days?
Absolutely, Niraj. It'll be Zydus Life. I think Zydus Life is in a very continuous uptrend. It's showing a lot of strength, remaining above 900, 920, which is a very strong support for medium term. You can look forward to the stock, testing 1,050, 1,100 odd levels in the medium term as well. So any chance for a buy on dips, maybe around 960, 950 would be that ideal zone to just reinitiate the longs, keep a stop loss at 900 and look for targets of 1,050 to 1,100.
Okay. Well, we need to slip into a break. But Hemang, Jani, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time this morning. Sony, stay on. Lots more to talk to you about. We'll take a quick break. Be back with the pre-open session.
All right, just a couple of minutes left for the pre-open session. And now, it's difficult to decide what kind of a move to make when there is so much data expected and so many triggers expected. Look at what's happening in the next 2 to 3 days. Just in terms of what an investor would be looking at, Bank of Japan is going to possibly for the first time in 17 years, exit a negative interest rate regime. Will the Fed give any indication of when the rate cut cycle will start? Is it going to be postponed even further because of hotter than expected inflation in the US? Back home, Thursday is a day when you will have even more data and enough data points to link corporate donors with electoral bond recipients. So which party got what? Anyway, you have that election overhang all over. So what are the stocks that you look at in a market like this? Soni Patnaik is joining us for more on that from JM Financial Services. Soni, before the break, we were talking about Poonawalla FinCorp, HDFC. There are a bunch of notes today talking about the private bank space as well. Whether it is a Macquarie note, whether it's a Kotak, whether it's an Axis. I just want to understand from you whether any of this is looking attractive to you right now, and what would you say about a Poonawalla FinCorp in particular?
Like if we talk about the private banks, they have by and large quite underperformed in comparison to the PSU banks, and they've not yet shown that leadership skills, just to help Bank Nifty take across the worldwide. So I think from all the entire stock or entire thing, I think ICICI Bank and HDFC Bank are still the two stocks which are looking decent when it comes to technical and derivatives data. Talking about HDFC Bank, irrespective of all the recent news and recent impacts that we have seen, the stock has formed a range of 1420 on the downside, which is a very good support, 1460, 1480 as a resistance. I think this is the range it has gotten to. Any break above 1480, you can see the stock heading towards 1550 also. I think the stock has corrected enough. I think that phase is over. So any small dip that you can see in HDFC Bank towards 1420 should be a good opportunity to just re-enter, initiate your longs, look for the targets of 1550. So it may take a month or 2 months for the stock to particularly reach that level. And talking about ICICI Bank, I think ICICI Bank has also held on to very strong supports of 1000. Any declines towards the support should be a very strong reinitiation point for longs. Stock has the strength to test 1200. It may be a short to medium term sort of a play for the stock. So, just look forward to buying on the decline. So I think both these stocks can outperform when it comes to the private sector bank.
Right. We also have it. Right. Go on, Soni.
So if we can look at right, so Poonawalla FinCorp, there's just a resistance of 490. If the stock can go above 490, then you can see further upside towards 520 plus levels.
So 490, if that gets taken out 520 on Poonawalla FinCorp, the stock is expected to see a good start. Well, pre-open is also what we are eyeing right now. It's going to be an average opening for the markets, no fireworks, flat start. 22,000 for now, and I wouldn't be surprised if 21,900 gets retested in today's day of trade as well. Well, we have with us Rahul Arora as well, CEO of Nirmal Bang, joining us to talk about the markets. Hi Rahul, good morning. Thanks for joining in. Rahul, before we go into conversations around Tata Sons and sector-specific conversations as well, give me a sense of what you're making of the markets. Of course, the big event is the elections. But more importantly, historically, at least we've seen buy the rumor, sell the news. Now, really, there's not too much of a rumor in this case or a guessing game in terms of what the outcome is. But it feels like the markets are lacking any sort of trigger at this stage. Do you agree? What is the next big event that could help the markets one way or the other?
Good morning, Samina, and thank you for having me on the show. So I think it's the correction that you've seen in the market has been long overdue and most welcome. I think whatever the reasons may have been, everyone acknowledged and knew that there were excesses getting created in the market. And while there hasn't been a very material correction, whatever pullbacks you've seen in stocks, 15, 20, 25% is certainly welcome because it has come after a time when stocks have gone up in multiples. As you rightly said, immediately there are no triggers to pull the market in either direction. I think all eyes will probably be on the IT earnings, which will probably start around the 10th or 11th of April. It'll give us a sense into how clients in the United States are thinking about the rest of the calendar year. And I think that's very important because you remember, Samina, the one call that everyone got wrong in the last calendar year was the US recession. I don't think anyone anticipated the strength of the US economy and the way it panned out. But obviously, as the year wears on, there is talk about interest rate cuts, both in the United States as well as in India. And that's going to be positive from an equity market standpoint. But I think in the immediate future, say between now and the earnings, I think it's probably going to be a little lackluster with a downward bias. But I'd still say if you're a slightly long-term investor, if you have a 2, 3, 4-year horizon, it's still a good time to be buying in. I think, none of us are experts in when to time a stock. If you feel your price has come or close to where it is, you can start averaging on the way down. But I don't think in the immediate month or two, you're going to be expecting a tearaway rally or anything of that sort. I think it's probably going to be consolidating, and that's probably best for the market, I think, at this point.
Agree. It's a time, it's a price or time correction, and the time correction is much needed right now, Rahul. We were discussing this early this morning, and I wanted your perspective on it. There is conversations around where a lot of investors outside, of course, are talking about the fact that China is now, China has looked attractive for a very long time, but the macros haven't been too supportive. Valuations surely have. Things may be just maybe coming together for China right now. Do you think the next couple of months, the next couple of quarters, China could give us a stiff competition in terms of, drawing foreign inflows into the equity markets, not the bond market, of course?
So I think, Samina, the one phrase you've probably got tired of hearing is that the entire world is moving on a wave of liquidity. So I think liquidity is not owned by any one country or any one asset class. Obviously, if China on its base can show you a growth that is similar or higher to, say, a lot of other emerging markets, why not? I think it's been out of flavor for a while, as you said. And every now and then, I think you see data points or you hear data points from China which believe they'll probably come out of the woods. And, as a corollary trade in India, you start seeing the metal sector do well, or you'll start seeing, companies that have exposure to China like Tata Motors, etc., doing well. But it's too big a behemoth, right? And I think if you look at the United States and we keep talking about the GDP there, I think if the US is growing at, 3-4% annualized or even 2.5-3% annualized on that base, it's not a bad number. India was projected to be growing at 6-6.5% not too long back till we had the stellar GDP numbers that came out not too long back. So I think it's a definite competitive threat in terms of capital flows just by virtue of its underperformance and the flows it's seen out. A lot of global investors do look at China very closely. And let's not forget, Samina, when you talk about global funds, in the last decade or so, I don't think you've seen any India dedicated fund from global investors open up. We're still part of Asia emerging funds or global emerging funds. So I think the way flows can move within those are very, very quick. So I wouldn't write them off. But like I said, it's worth keeping an eye on because there is a trade in India to be made as far as China recovery is concerned. And, in sectors like autos and metals, and you probably wouldn't want to lose out on that once you start seeing positive data points from there. So keep an eye out, I'd say.
All right, some big news coming in globally. The Bank of Japan has set its policy rate in the range between 0 to 0.1%. So the first time after 17 years, Japan is exiting the negative interest rate regime. Let's pull up dollar yen as well. So this is actually a big story breaking right now. They've scrapped their policy to control deflation. They've gone between 0 to 0.1% as a policy rate. They were the last nation in this world actually to exit that negative interest rate regime. Rahul, we've got you just at the right time today. BOG has scrapped the yield curve control and has tweaked asset purchases as well. We're waiting for all of those details to trickle in. It was expected perhaps to happen in April. It's happening in March in this policy. We want to understand what the impact is going to be, not just for Asian markets overall and Japanese markets, of course, but from the Indian perspective too.
No, so I think, Tamanna, this is actually a good thing. And I think, the good part is that if Japan has inflation, and it's been a market that has been so silent and dead for such a long time right now, that if you actually are starting to see positive signs of inflation, it's actually not a bad thing. It means that, there are parts of the Japanese economy that are doing well. Now, whether this is commodity related or consumption related, I'm not exactly sure. But it'll be interesting to see how the dollar yen pans out. I think from a carry trade perspective and, what it could mean from a dollar parity perspective. But I think in India, I think the one thing that stood out from an external sector standpoint is that, and I think that's probably helped the government from a fiscal deficit standpoint as well, has been that the rupee has been stable around 83. I mean, so much has happened, right? You've had 2 wars. You've had interest rates go to where they are, and yet you've had the rupee being at around 83, and crude has been stable around 75, 80. So I think at the margin, I don't see this having a direct impact on the currency at all. I think we'll probably be stable where we are. But I think India's external sector today is far better than a lot of our other peers, both from developed as well as developing economies. But yeah, I mean, if I'm sitting in Japan and looking at these numbers, if it's consumption driven, I don't necessarily think it's a bad thing, because it's an aging population. And if you're getting a positive take on interest rates and they're anticipating inflation, it may not be the worst thing.
All right. I just want to understand from terms of fund flows to emerging markets, including India, do you see any impact over there at all, Rahul?
Well, obviously, if Japan is going to start offering you positive interest rates, you might see some money going there, right? I think the money always chases where interest rates are higher. And you saw that in the early phase of when the United States was raising rates as well. You did see some amount of outflows that went out from India into the United States, because once the carry on the interest rates becomes narrower, you're probably safer in playing developed markets than you are in playing developing markets. So I think from that perspective, going back to your earlier point about China, I think the one that Samina raised, at the margin, I think this could potentially create another avenue of competition for capital, but I don't know how substantial it will be, because the interest rate is just about 0.1%. But can it at the margin help in global flows going there? For sure it can.
Rahul, Niraj here, good morning. Just the implications of what it does to maybe borrowing costs as well, not just for Japanese companies, but for companies which do the yen borrowing as well. Is there a large India implication here?
It all depends on how much you borrowed in terms of Japanese denominated bonds, Niraj. I think, you can think of one large auto component company in India that has a very large Japanese presence. There are one or two conglomerates that have raised a lot of money from, central banks, from private banks in Japan. So I think all of this was to bring down the weighted average cost of borrowing that they had. We have seen similar cycles when ECBs were being raised, when interest rates were very low in the European Union as well. But it all depends on the quantum. I mean, if I have a $100 million loan, for example, from any of the Japanese banks, and I see my interest rate going up by 0.1%, but if it's not going to affect my cash flows in a very major way here, if I'm a very profitable company, I don't think at the margin it's going to make that much difference. But yeah, obviously the interest costs will go up to that extent. But I don't think Indian companies, the listed ones to my memory, have had such large borrowings from Japanese companies that this would move the interest rate very materially for them, and that their cash flows won't be able to fund it. There are 3 or 4 companies that come to mind, and I wouldn't want to enlist them. I'm sure you know which ones I'm alluding to. But I think a 0.1% for the kind of cash flows that those companies enjoy, I don't think is going to dent their P&L in a very material way.
See, was one that closed a large yen bond deal and raised 3,500 crores in early Jan. But I'm guessing all of this comes in with, those contracts are watertight, Rahul, to say the least. But yeah, it'd be interesting from a carry trade angle. The dollar yen is, of course, having quite a move in trade as we see it. The currency markets have also opened up. So it'd be interesting to see how those cross-currency pairs actually play out. I think the dealing room, Niraj, Tamanna, is going to be a good space to be in this morning in the currency dealing room.
But I wonder if the Nikkei is showing that spike.
Pressure.
Just get the Nikkei up on the screen, because it could be, while at times they're 0.36%. So nothing dramatic there on the Nikkei thus far. Let's just wait and watch what happens.
You have seen the pressure coming in last few sessions already, because this was being anticipated as well, that there would be, an increase. But
there's a triple-pronged moves.
Yeah.
Rates,
Yeah.
YCC, and purchases of risky assets. We don't have the details as yet. But that could actually mean a decent rise for the Japanese market. I think these rates are stuck. Let's just move out from the Nikkei thing. But it could be very interesting to see what the Nikkei does today on the back of this thing, and whether that has a resultant impact on some of the other Asian markets in the session today.
Yeah, absolutely.
We've settled as well, by the way, the pre-open session.
The pre-open rates have settled. Let's just pull that up quickly before we get your top brokerage notes of the day. Pre-open rates are settled, but you are looking like you're in for a weak start. There's no doubt about that, at least initially. All right, Macquarie says investor mood has become cautious on Indian financials. Harsh is joining in for more. Yes, Harsh.
Well, Tamanna, I'm going to try to keep this quick. Macquarie actually met 40-odd investors in their financial roadshows. They seem to be cautious with regard to Indian financials. HDFC Bank, they believe, still has value, but investors still not confident. Still some amount of headwind to go before it starts to re-rate. Shriram Finance, though, is largely the consensus overweight for investors. PSUs is something investors are looking favorably at a time when you're seeing pretty much a lot of headwind on the deposit side of things and liquidity side of things. With regard to fintech, no interest currently in Paytm, at least till the dust settles. PB Fintech valuations look stretched according to Macquarie, and investors believe that re-rating has already played out. HDFC Life, they believe there is a challenge with regard to growth, largely on the back of the fact that HDFC Bank is focusing more on garnering deposits. SBI Life is the preferred pick among insurers, and SBI Cards is a consensus sell given multiple headwinds that are playing out in that space. Now, with regard to the larger trade, they are looking at long PSU banks, selling private banks currently, and the Macquarie view is that in FY25 growth will be the largest casualty. That's largely the Macquarie view.
Okay, Harsh, thanks so much for that. Sony, will come to your stock recommendation after this, after the market open, because just 15 seconds left for the markets to kickstart trade. We'll keep BOJ on hold for the next 3-4 minutes until we mark the markets, Indian markets, and then come back. Remember, TCS has started off negatively, so we'll have a start somewhere down here for Tata Consultancy Services. Let's look at what some of the others are doing. So this is, of course, the Nifty 50, a third of a percent in the red, I believe, led by Nifty IT. Let's bring up Nifty IT, possibly amongst the big casualties today, 1% lower. Are banks participating? Quickly bring up the banks and then the heat map. And no, banks aren't participating, so banks are okay. Nifty IT is dragging the markets lower. This is the heat map. TCS down the order. Metals, after a rally yesterday, just pausing a little bit. But it is essentially IT and essentially TCS, 2.7% lower. BPCL is still down. Some losses for a Wipro, Bajaj Finserv, SBI Life, Bharti Airtel. But nothing too untoward. It's effectively TCS on the losing side, and not too many gainers. The top gainer is ONGC, followed by Adani Enterprises. Both of them are down, or both of them are up less than 1%. That just shows you that the only talking point in the market at the start, while we are down about 0.5%, is what's happening to Nifty IT and TCS in particular. Though I must say, metals are also participating, or commodities are, because Tata Steel, Coal India, Reliance, all of them are down. So the culprits are Reliance and TCS, which are dragging the markets lower. Down about 90 points on open. Tamanna.
Yeah, TCS, because of also what Tata Sons has valued it lower than what their buyback costs were, so 2.5% down. But we're going to be focusing on what's happening in the broader end of the markets and some particular stocks there. In fact, let's see if we can pull up, yes, the Nifty mid-cap. Not too bad compared to the Nifty. Let's pull up the small cap index as well. So a bit of weakness there. Specific stocks that we're talking about this morning, and of course, while TCS remains top of mind from an Indian market perspective and from the Nifty perspective, I just want to pull up Poonawalla FinCorp as well. That's a counter that we've been talking about since the trade set up in the smaller space. So that's 2.5% up, nearly 3% up, and that's all management change. They have an MD and CEO, a new one, who has moved from HDFC Bank, was heading their mortgage business, Arvind Kapil. And that is looking as positive for Poonawalla FinCorp. Balkrishna Industries is the other one that I have on my radar. They have been under pressure for IT raids, and a clarification now coming from them that those raids have ended. Completely flat there. JSW Energy is the other one. They have clarified on their bond purchases, electoral bond purchases, saying that they have not given any to JDS. Nevertheless, 1% down on that counter. L&T Finance had okayed, their board has okayed raising money through NCDs up to 1 lakh crore rupees. That's the overall upper limit. That counter about 1.5% up. Just Paytm once again, because the way this stock keeps going up despite all the broader headwinds is interesting. 1.5% up this morning in trade on Paytm. So those are some of the stocks that I'm spotting, but I think the morning's all about TCS, Samina.
It is. TCS is your biggest loser on the street. In fact, worth noting is when TCS had conducted the buyback, it was at 4,150 rupees. Tata Sons clearly valuing it at a much lower price. So the stock is under pressure on back of that bulk deal. Well, you want to also, Niraj mentioned that stocks like Tata Chemicals may see some further selling in today's day of trade, as now it seems almost conclusive that the Tata Sons listing is out of the way. Flat, no major reaction on Tata Chemicals just yet. A few other stocks that are moving in today's day of trade that are worth mentioning. Tamanna has, of course, mentioned the likes of Poonawalla Fincorp, but that is seeing very big volumes also in trade. So it looks exciting in that sense on Poonawalla Fincorp. Up 2.5% is what we have. Piramal Pharma is turning out to be a top gainer with a 5.5% rally this morning. And again, it's gaining on healthy volumes as we see it. You've got 197, once again up in trade, 2.5% up move, yet not on an upper circuit there. You've got Adani Energy Solutions doing well. They sold off a little bit in trade yesterday, so recoup those losses from yesterday and added some more this morning. 2.5% on Adani Energy is what we have. Well, you've got Solar Industries looking good. In fact, the whole Adani pack is trading with a very clear positive bias with gains anywhere in the range of 2 to 3%. Adani Total is also up 2%. Adani Enterprise in large cap space and ports were doing well, but Energy and Total are both trading with a gain of 2%. Some of your metal names are doing well. Pull up REC. Let's see what's happening with that stock. We were talking about how with an increase in interest rates in Japan, that 3,500 crore bond that they raised in those Japanese markets could be impacted, but no impact. REC actually trading flat to slightly higher in early trade. Cochin Shipyard is up about 1.5%. Shipping Corporation of India, let's pull that one up because they are subsidiary, or in fact, the Shipping Corporation of India Land and Investments is set to debut on the street today. The stock was up 5% on SCI in trade yesterday. Today, of course, doing okay. Gensol is up 5%. Anup Engineering is seeing a 4% up move. These were smaller stocks that were on the radar this morning on back of stocks and news. Gensol seeing a 5% up move. You've also got a move coming in on RateGain, which is up 2% in trade. Lemon Tree is also trading with a gain of 1%. PNB Housing, some of the other counters that are looking good. On the sell side, it's another down day. Tata Investment Corp seeing another 5% cut. So it's down about 25% now in the last 5 days. Relentless selling and downward circuit on Tata Investment. TCS is the other one, which we've already talked about extensively. But largely speaking, Niraj, Tamanna, no major trend emerging. It's largely stock specific. Yeah. But this Tata Investment is something I personally can't get my head around. It kept going up a circuit and now
overvalued so badly.
Yeah.
Like about time that this happened. But
have they reversed all the gains?
No, they've given up only 25% yet. They were up about 285%.
So some ways to go.
Long way to go.
Yeah, but just a quick detour because we got a guest on this BOJ decision. So a quick view from Anuj Gupta. He's head of commodity and currency at HDFC Securities. Joins us right now for his quick perspective. Anuj, good having you. Thanks for joining it. Good morning. What do you believe are the implications of the BOJ move?
See, after the 17 years, they, increased interest rate from minus 0.1% to 0%. So basically, they ended this yield curve to control the policy. And I think this is a positive impact on the Bank of Japan. So possibly, the interest rate will, put some pressure on other currency. Might be, you can say, we are expecting some, depreciation in USD INR. Possibly, we are expecting the rupee may depreciate a little bit towards the 83 levels.
Sorry, did I hear you say you believe the rupee would kind of settle at the 83 levels to the dollar?
Yeah, definitely, because when the Japanese yen is strength, I think possibly rupee may depreciate, and rupee expecting to depreciate further. However, dollar index is trading around a 103 levels. And dollar index is also waiting from the Fed policy, which comes tomorrow. So possibly market may be very volatile in terms of the currency segment, and possibly due to this expecting some little bit depreciation in rupee. However, recently we saw appreciation in rupee in last 15 days, but now market is awaiting also for the federal bank policy. Possibly due to this, we'll see some volatility in the rupee. However, Yesterday we saw some depreciation in rupee, possibly expecting a depreciation in USD INR, and it may test 83 to 83.10 levels.
Anuj, I want to talk to you specifically about the dollar yen, because I know with the yen borrowing that happens, a number of corporates in India either go out and hedge their exposure in terms of their ECB, or you also have structures that are long dated in nature with knock-ins and knockouts. Considerably lesser now than it used to be a decade ago. But where were positions as of yesterday on the dollar yen on the cross-currency side with a lot of the banks and corporates? And also, secondly, what will this now do for hedging cost?
I think now the hedging cost will increase because earlier interest rate was in minus, and right now interest rate are at zero. So possibly the corporates who are hedging the position, possibly the little bit, it will be costlier to the hedgers who are hedging with the dollar yen, because right now the interest rate are zero, and actually Bank of Japan is now yielding curve their policy, and this will impact on the the hedger side, and this will be costed to the corporates.
Thank you so much, Anuj Gupta, the head of commodity and currency, talking about what the impact is going to be. Let's pull up the Nikkei very quickly, and there you are seeing sell-off deepening as the BOJ makes this historical move. We will, of course, through the day break down implications, etc. But let's just shift focus back to the markets shortly after open, where you are seeing weakness persist. The Nifty almost 0.5% down now. Rahul Arora and Soni Patnaik still with us. Rahul, I want to come to you on what you think the trend is going to be in the run-up to election season. You're going to have about 2.5 months where polls are going to dominate. Do you think that this is a factor at all that markets are going to be looking at, investors are going to be looking at, or are most market participants sitting pretty, having concluded that there is going to be policy continuity post the 4th of June?
No, so I think cash levels would have definitely gone up, especially with the kind of directives that have been coming out of late. I think if you looked at pre this correction, I think mutual funds on average were sitting at about 3% on cash. So I think those levels might have gone up. But I think from a market perspective, I think, if you're looking 5 years out, if you assume the current establishment was to take office again, I think it's going to be a very economically friendly market condition. And if nothing goes wrong globally, I don't see why the market on average can't compound about 15% CAGR over the next 5 years. That doesn't mean you will get 15% every year. You may have a down year, 1 year, but you probably make it up another year. So I think if you're taking that call, and I think the way the Prime Minister has been thinking, it's going to be manufacturing led. And when I say manufacturing, I don't necessarily mean defense. I think there are so many other aspects to manufacturing that are not represented in the index today, but might find their way in some way, shape or form. Whether you talk about hydrogen, green energy, semiconductors, alternates, there's just so much happening out there. So my sense is that it's going to be very manufacturing driven, and we need to find the right kind of companies to invest in. On physical infrastructure, even though the finance minister announced that, at an aggregate level, there's probably a step back, sorry, because they want private sector to come in. But even then, I think with the kind of focus that's going to be there from private and public sector on infrastructure, cement could be one very good play to be making. So, and, we were discussing China a little earlier. If the Chinese economy comes back on track and global demand is all right, and the dumping and the destocking from China stops, chemicals could make a comeback as well. So there are pockets of the market where value is there and emerging. And you also have to probably try and see which themes are emerging over the next 3, 4, 5 years, which may not be very obvious to the naked eye today, but may find, you could potentially find very decent multi-baggers in those if you're able to find the right stocks, listed or unlisted today.
So cement, chemicals will be interesting spaces. Rahul, I also want to get your view on, I think, the stock of the morning, which is TCS. That big stake sale or the big block deal has happened this morning with Tata Sons offloading, some of its shares. The stock about nearly 3% down. The fact that the price at which Tata Sons is offloading is lower than even their own buyback, maybe a negative sentiment. How would you look at a TCS right now and the space?
So I think, Tamanna, when you look at the frontline IT companies in India and say frontline FMCG companies in India, these are very mature businesses, right? I mean, if you look at, say, a Lever or things like that, I don't think these are companies that are going to consistently give you 10% top line compounded. I think those days are well and truly gone. I think the pivot point for both IT and mature consumer companies remains about 5%. I think in bad years, that growth probably tends down to 1 to 2%. In good years, you probably get 7 to 8%. I think the big lever that a lot of IT companies are going to leverage on is going to be margins, utilization, and how they can optimize whatever third party or subcontracting costs that they have. Rupee depreciation is just one aspect to it. That's not why you would buy a company. But I think something like a TCS gives you a free cash flow yield, and this is true for the IT companies as well. It gives you a dividend yield. It offers you buybacks from time to time. So in an uncertain environment, it becomes a kind of hedge. Like how you say gold is a hedge against inflation and investors buy gold. IT in some ways could be a hedge in an uncertain market environment. Add to that, if the market gets it wrong again about the US recession this year, this could actually land up being a sector that outperforms. Actually, Tamanna, if you go back and plot the last 10 years in terms of returns, the IT sector has outperformed any sector in India. I don't know how many people know that. It's actually given you more returns than even in the banking sector by about 1.5 times. So I think it's a very safe sector to be invested in. And I would use
Rahul, sorry, but here's my question. You always spoken about, right? Past performance is not be an indicator of future performance. So, and Sony, will come to you after this. Please stay on. But just one quick follow-up, Rahul, to you. Since past performance is not be a factor of future performance, and since CEO after CEO is coming out and saying there's no change in demand environment, what's the need of putting money to work right now in IT?
No, so that's the call, Niraj. I'm not saying that we have to put in IT. I'm just saying that, if you get into a situation where you see the markets consolidating or going down, this could be a good defensive bet to play. We at our brokerage house have a sell on all the IT stocks, barring Tech Mahindra. And I think the reason we have a buy on Tech Mahindra is because the margins are so depressed, Niraj. I think they're about 5-6%. My IT analyst Girish's view is that margin will probably head to 12-13%. So the earnings growth in Tech Mahindra could potentially be the high. So that's a very company specific thing. But like I was saying a little earlier, do you want to be paying 20 times, 25 times for a company that's giving you mid-single-digit growth? That's a question you need to ask, and you need to ask that question in FMCG as well. I mean, it's a sector I've looked at very closely. Do you need to be paying 40 times multiples for companies that are giving you 1-3% kind of volume growth? So I think these are saturated businesses. They are good defensive bets, but when you're looking to make money in an aggressive market, I don't necessarily see these sectors playing out as outperformers. They have good free cash flow and dividend yield, like I was saying earlier. They give you buyback options, so shareholder return options are there. But in absolute terms, I'm not sure, the kind of money that you can make, because it's been such a rank outperformer in the past.
Right. Thank you, Rahul. Great talking to you today. We'll hopefully connect soon and get more perspective from you. Sony, sorry, we had kept you waiting a while with everything that was breaking news in every sense. Very quickly, your first reaction on today's opening, and if you've spotted a trading opportunity for our viewers.
I think yes, Tamanna. So if you look at Nifty still hovering around its support of 21,900, not much to read into that until and unless it's not breaking below 21,900. There could not be any chances of further sell down. So I think just wait for those levels. And in terms of any trade, the morning trade can be looked at for PI Industries, looking quite strong. Yesterday, it has given a very strong breakout on intraday charts. Even today, if you look at its cross the resistance of 3720 and current CMP is 3740, it can definitely head towards 3800, 3820 with a stop loss of 3750.
Right. Thank you, Sony. Thanks for joining us today on the show. That's PI Industries with Sony's buy call. Well, on that note, we'll take a quick break. It's the morning where history has been created as Bank of Japan breaks its negative interest rate regime after for the first time since 2007. So I guess the dealing rooms, currency dealing rooms in India must be a toss with a lot of activity as we see it. We'll take a break. We'll come back. We'll talk to UBS's Tanvi Gupta Jain on the election outcome scenarios. Please stay tuned.
All right, poll season has begun. What are the possible outcomes we can see from this election, and what will be the impact on the Indian markets? UBS has come out with a note on this where they've looked at 3 possible scenarios and what their impact could be as far as investors are concerned. Tanvi Gupta Jain, India economist at UBS, joining us now to speak more on this. Tanvi, great to have you back on NDTV Profit. Superb to be speaking with you today on the note. Now, you've looked at 3 possible scenarios. In scenario 1, the BJP is the single largest party, has a majority on its own. Scenario 2, it's in a coalition. And scenario 3, the India Alliance comes to power. Do you have a take on what is most likely and how markets would react to each?
Okay, thank you. So before I start, let me start with my disclaimer that at UBS, we do not predict the election outcome. And we do know that opinion poll, exit poll have been wrong in the past. That said, we did try to look at the various election scenarios possible, which we just highlighted, talking about BJP single largest party, BJP-led coalition, and the third option is a weak coalition led by India Alliance. I would say as of now, based on whatever opinion polls are available, they are hinting that Prime Minister Modi remains the most popular leader in India. In fact, even if I look at the recent performance in assembly elections, it also showed that the Modi factor or the perception of work done and even the implementation of the welfare schemes were in favor of the BJP government. So at this point, most of the opinion polls are pointing to political continuity. Our discussion with investors at the same time, looking at the valuations right now in the market, I think the first 2 scenarios seems to be already priced in.
In your scenarios, you also talk about if the BJP comes back as single largest party with a clear majority, which it also had in 2019. An alliance is running the government, but the BJP has a majority on its own. Then the positive private capex cycle will begin. That's, one outcome. Possibly. What I was wondering, Tanvi, is that the conditions in that case for the positive private capex cycle to begin already exist from the last 10 years. Why have we not seen it then, in that case, if the factor was a full majority of the BJP? And then what changes if they come back?
All right. Very, very valid question. So if you look at the underlying drivers for a capex cycle recovery have now turned positive in terms of asset quality of the banks, which I think in the last so many years, we did see a lot of cleaning up of the banks book happening. And finally, we are seeing a double-digit buoyant credit growth, even though it is more biased towards consumption. And I really hope that we start seeing corporates, the larger corporates, start asking for credit because in the hope that there will be a private corporate capex revival. And second is, even if I look at the balance sheet of the corporates, I think a lot of corporates deleveraged their balance sheet over the course of the pandemic. And now for the first time in a decade, they are in a much better position to add more or take on more debt to expand capacity. The third driver of the private corporate capex cycle, which is, I would say, is much anticipated, we are yet to see it in a big way, is that if I look at the funding, taken up by the banks, by the corporates with, or I would say the RBI has started releasing that data in terms of funding secured for capex. And that is also showing a very sharp pickup, especially in the first half of FY24. We only have the data available from April to September. And the last data point is the capacity utilization levels. we have seen that capitalization levels have picked up from the low of 60 to almost close to 76 right now. If I look at going back in data or going back in history, normally when capitalization levels are around 78, 81, we do see companies or the corporate sector beginning to expand capacity. So when I say political continuity, it actually bodes well for business sentiment. And we really hope that the much anticipated private corporate capex recovery actually picks up post-election. So that is something which we are estimating. In fact, I would say in those scenarios, I would even expect further progress on supply side reforms, whether it is in terms of clean energy transition or high infrastructure spending, not only soft infrastructure spending or digitalization, but also a lot of focus on physical infrastructure spending, a larger manufacturing push. And at the same time, what the BJP government has kind of highlighted in the budget, targeted policy initiatives, whether it is youth, poor, women, and farmers. So I would say you need an overhaul of many things to work for the overall broad-based recovery in private corporate capex that we hope to see at some point in time.
That's what I was curious about as I was going through your report, Tanvi, that what's on the list left to be done? Because if you look at the entire, and of course this happens pre-poll, if you look at the entire campaign, it is that all the promises made have been fulfilled. That we're already on that growth trajectory. A lot of the reforms have already come into place. And I'm wondering what remains that would be key to the markets and, in the hope of not just this positive private capex cycle, but going to the next level.
Absolutely. So what we did was we actually looked at what could be the impact on different reforms and the various government scenarios, depending upon the three scenarios we talked about. And we looked at some 8 to 10 parameters, whether it's fiscal discipline, whether it's infrastructure, whether it is further digitalization push, divestment, FDI, PLI, including, something like a land acquisition bill or a uniform civil code. So I think what more can happen definitely are three things. One, a big push towards physical infrastructure, which India is still needing as per our estimate, while a significant digitalization push has actually helped in improving productivity and efficiency levels. We still need a massive push towards physical infrastructure spending. Maybe taking it towards 7 to 8% of GDP on a more sustainable basis for India to move to a higher growth path. So that is the first part. Second is PLI. We are already seeing the government has expanded the PLI. They have identified 14 sectors. There is an incentive scheme in place, but definitely we need much more further boost in terms of other easing of regulations in trying to boost the manufacturing push towards India. Third is a land acquisition bill. I think maybe another attempt could be possible. So I would say even in the rural economy, maybe there could be more focus on structural reform. So definitely there are a lot of possibilities where we do see that to help India move towards a higher growth path, there could be more policy push needed at this point in time, largely on the supply side reforms.
Tanvi, just the thing around what a policy continuity could mean for FDI, and because India's share of FDI has fallen quite considerably in the recent past, one of the thoughts is, and I would love to understand how you think about it, one of the thoughts is that because commitments are being made into futuristic sectors wherein the pace of investment will become large with the next 2-3 years, so you will actually start seeing the material physical flows only in maybe 25, 26. Would you, if there is policy continuity assuming, would you believe that to be the case?
Okay, so the way we do it is we looked at FDI in sectors, and what we realized is that if India was getting FDI inflow of $60 billion, we are right now tracking FDI around $40-45 billion. When you look at the net FDI number and you say, wow, FDI has actually halved, that is largely because a lot of repatriation of FDI outflows has happened in the last couple of years. So I won't completely, yes, partly I would agree that it is the newer sectors where, we would expect FDI to pick up. In fact, if you look at UNCTAD survey, they are saying India is one of the few countries or the top 5 countries where the greenfield investment intentions are very high. And if you plot that according to the FDI inflow chart, you do see that they do tend to move in tandem. There is some lead and lag. But at this point, even we are hopeful that the FDI inflow will pick up. But I would say at this point, we are still getting $45 billion of FDI. If I look at manufacturing FDI, which is the most important metric to track, to look at how big the meaningfully the supply chain shift to India happening, that number used to be $8 billion a decade back. Today it is somewhere between $14 to $15 billion. So in that sense, yes, there is a significant improvement. But yes, for FDI to really pick up, we definitely need much more massive manufacturing push in the country. So the hope is in the next 3 to 5 years, FDI flows start to pick up. But at this point, I think it is more because of the weak global capital markets, private equity deals not really happening, and that does flow into your FDI inflow number. And the third is a massive also repatriation of FDI outside the country.
Okay. Tanvi, net, just trying to think out, 5 years out, do you believe the numbers will look stratospherically different? I know we are out of time, so just take one quick question. Do you think the numbers will look stratospherically different than what they are looking right now?
Absolutely. I mean, if I'm very confident that India is on a 7% GDP growth track in terms of higher potential growth, the FDI number, which you are seeing right now, roughly around $45 billion, would definitely be in the range of $75 to $90 billion dollars in the next 5 years.
Great. Okay. Tanvi, so good having you. Thank you so much. Would have loved to talk more, but I understand we have to let you go. But thanks for taking the time out and being with us today.
Thank you.
All right. That's Tanvi Gupta Jain, UBS, on the report that they wrote. We need to slip into a break on the note that the equity markets are, well, quiet. Nothing too dramatic. No big fall or no big rise. Just about that 0.3% kind of a downtick, led down by TCS. We'll be back from a break with more conversations. Antony Waste is in focus because they have won orders recently, but they're also branching out into a number of different things, and hence conversation with Mr. Iyer Subramaniam NG, the CFO of Antony Waste Handling, is important. Mr. Subramaniam, good having you. Thanks for joining in. Give us a sense of what all have you branched out into in the last 3-4 months since we spoke, and then we'll of course talk about your Q3 numbers and the recent order wins.
All right. So over the last couple of quarters, couple of things which are already in the pipeline started culminating into operations. We started our waste to energy project, which was a big aspect for us. So we started commercial utilization of the asset from 7th of October. So that was a big deal for us. So that started off. Second, more important is the construction and debris waste processing. That has almost started completing its construction phase. So we start looking at commercialization of that from the first quarter of the next year. So those are two critical things which makes Antony go more into processing and less into collection and transportation, because that's where the margins are and that's where the need of the country is today.
Okay. Are these the reasons why your margins showed up so significantly in quarter 3, or was it a base effect of quarter 3 FY23?
Partly because of the base effect, but more importantly because of the change in the revenue mix. Pre Q3, my revenue mix predominantly was skewed towards project revenue, which is predominantly an Ind AS accounting treatment, wherein I need to recognize the capex through the income statement, which is a low margin business. Come Q3, my capex phase is over, so I started booking all those revenues into my core operating revenue, which is a high margin business. So Q3 is reflectively the core assets being put to use, being reflected in my numbers. So pre that it was more of a padded up numbers because of the accounting treatment. Now going forward, core revenues and the core costs will be sitting on my books, and that shows in that slightly better margins.
Okay. No, it's not slightly. From 13.55 to 20.33, if this is slightly...
For us, that's slightly.
I wonder
that's
what's going to
trend
happen
for us.
Okay, no. So let me try and get this clear. You talking about embarking upon a couple of projects which are higher margins, and while they have not fully fructified into your numbers, you've improved margins to 20.33%. Am I to assume that over the next 24 months, your normalized EBITDA margin performance could be higher than the 20% mark?
We are targeting somewhere between 22 to 23% to be our EBITDA margin, because that's a steady state of affairs based on our core operating performance. So that is something that we're working on. So 3 projects that's likely to drive these numbers are the waste to energy, the construction demolition waste, and the recently bagged CIDCO biomining project. So these will give us support in forms of margins of betterment for us.
Okay. So how large do these pieces become? Because when I look at your revenue contribution as of now, and please correct me if I'm wrong, processing is 20%, contract is some 26%, CNT is some 54%. So what changes in this mix over 24 months?
Over the next 24 to 36 months, we would see CNT business contributing around 55 to 60%. The balance 40% will be my processing, which is why you are seeing a change in the margin profile.
Okay. So contract and others, which is about 26%, will get
that gets flipped into my yes.
Okay. And does this have an impact on the earlier guided growth targets? Because I remember you telling me that you hope to grow at 20 to 25%, if I'm not wrong, for the next 4-5 years CAGR. Is that constant?
That will be constant, because that we are talking about is a core revenue. So based on the capex phase, which has now been completed, the core revenue growth starts coming in. So if you look at the Q3 numbers, my core revenue grew by around 19%. So that is something that we are targeting. When your CNT project and the biomining starts performing, that adds to my core revenue growth. That drives our growth numbers here. So anywhere between 19 to 24% is something that is comfortable. Any future project wins will add to that.
Okay. Yeah, so circa between 20 and 25%. I mean, one odd percent here and there. Okay. Tell us a bit about this biomining thing with CIDCO. It's a small order thus far. Do you believe that this pie can grow with multiple orders from other geographies, or can you deepen the slice with CIDCO itself?
Answer to that is both yes. We did Greater Noida biomining, where we kind of did around 2.2 lakh tons of biomining. So that was a very successful project. Post that, we did this, we bagged this CIDCO biomining, which is like an 8.5 lakh ton kind of a scenario, so which is like almost 3 times what we are looking at. So we are feeling confident that we can execute large kind of biomining projects here at a positive scenarios for us. The problem that India is facing, a lot of cities have open dumping grounds, and that is something of an eyesore, and it's also an environmental nightmare. So the only solution currently is to kind of get rid of these kind of dumping grounds and what we call as bioremediation or biomining of legacy waste. So we are seeing a larger potential over the next couple of years. And once you get your act together, once you know what works, what kind of machinery works, you are able to kind of really fine-tune your margin profile going forward. So the pie will increase for biomining as a segment for us. With CIDCO, it's one of the better run organizations, and there are always a processing contract or a CNT contract coming up. So historically, our experience has been that you work with a particular client and start giving him more of the projects. Like Nagpur, we did CNT and now we're doing power sweeping. PCMC, we did CNT, we are doing waste to energy. Similarly, with Sidco, we are doing biomining. Maybe in future, we'll try to do some processing activity with them as and when the tender comes up.
But okay, and the other question is this biomining. You mentioned a couple of things, a small one with Noida, if I'm not wrong, and the one with Sidco. Are you in talks with some other geographies for such projects?
So we are in talks with the larger cities currently, but because of the election code of conduct, everything's got into the mothball scenario, so it's going to take some time. But definitely large number of cities, let it be Chennai, Bangalore, you name it, large number of cities have this as a problem, and they are in talks with large number of players to find a solution. I mean, Delhi is one of the prime candidate for this scenario where they're talking about getting rid of the Ghazipur dumping ground. So it's a problem facing a large number of cities too.
Sure. So you've had a flat revenue growth in Q3. If the election code of conduct is in place and new orders don't come in, would growth come in from executing the previous orders, and will you be able to therefore match up to that 20-25% growth? Because the reason I ask you this also is when I look at the March 23 numbers, revenues is 850 odd crores if I'm not wrong, and the trailing 12 months is circa that number. So will you add to that 20%, or can we expect a bit of a flatline performance for Q4 and Q1?
Yeah, so if you look at the 850 odd crore of revenue, you need to split out the Indus accounting revenue, which is around 175 odd crores. So my core revenue was around 625, 630 crores. Now that is the pie that we talk about, which is going to grow at 19 to 22%. So that is a growth that we're talking about. Based on the new waste to energy and the CND and the biomining, that 625 will grow at around 18 to 20% comfortably for us. That is something that drives the margin for us, not the Indus accounting revenue. So that will grow for us.
The reported revenue, will that flatline, or will that also grow?
That will flatline. That will flatline unless until I bag certain more large CND contract. That will flatline over the next 24 months because of the absence of the construction revenue coming in.
But the margins still grow. Margins and PAT can still grow.
Yes, margins will definitely grow. PAT will be slightly subdued because of higher depreciation and interest costs coming in from the waste energy project. So cumulatively, we will see a 25 to 26 crore of depreciation and interest coming in over a trailing 12 months or the future 12 months period from the waste energy project.
Got it. Okay. Mr. Subramanian, one last question. Any fundraising activity in the near term?
Not yet. I mean, the balance sheet looks very strong. We have a net debt to equity of around 0.6x. We have A minus for our large subsidiary. The cash flow from operations are 110 to 125 crores. DSOs are around 100 days. So pretty comfortable today. But if we back few large waste to energy or waste processing contracts, when the discussion will be on the table then.
Wish you all the best for that. Thanks so much for talking to us this morning.
Thank you. Thanks.
Viewers, thanks for tuning in.